Cheers and welcome back, everybody. What I want to talk to you today is something that's been in my mind for a while, and I've never seen anyone talk about it, and it's narratives. What I see is, I could give you one or two examples. When the stock market goes down, for example, equities go down, it could be crypto to anything, the narrative changes. So if stocks kept going down, especially if they kept going down consecutive weeks, let's say the fifth week and then the sixth week and the seventh week, what happens is the narrative changes from, oh, stocks are having a correction to, oh, there's a recession coming. And I see this all the time where I actually play a game for myself. What I do is I try to guess what the news is just by looking at the charts, especially when there's a big move. And so that's why you have to be careful to, number one, you got to do your own research. And number two, you need to have conviction. This reminds me of the saying, you don't have, what is it? You don't have experience unless you make mistakes. And then when you have experience, then you could, do a good job at making decisions. Problem is, you first need to make mistakes. I'm not saying that right, but let's forget about that. Basically, what I'm trying to say is, it's hard for you to have conviction unless you've done your work. Because if you don't do your work, and I like to use the Malcolm Gladwell quote that you need to spend like 1,000 hours of doing hard work. If you don't do that, you're not going to get conviction. If you don't get conviction, you're going to start listening to all these narratives. And I even get fooled because even though I have conviction, some of my favorite and smartest, most experienced, and most successful people that I follow, like George Soros, and more recently, I'm going to talk to you about Jim Bianco and Stanley Druckenmiller and all these guys, and what's his name, Jeremy Grantham. These are really good guys, but even these guys make mistakes. And so I'm going to show you today using an example of Jim Bianco, who I think is amongst the best, creme de la creme, yet I disagree with him. Him and most everybody now is changing their narrative, but it's not on equities. Actually, it's on equities a little bit. In crypto, what they're really changing their narrative on big time is interest rates. Everyone is changing their narrative on inflation and interest rates. Why? Because interest rates have been going up. So instead of saying, oh, interest rates are going up and they're peaking, they're saying interest rates are going up and they're probably going to go higher. So I'm going to give you some examples of how they're changing this narrative. Let me see if I could find the LinkedIn article for you. Actually, it's right here. It's right behind me. I need to shrink myself. Shrinking, going away. Okay, here it is. Jim Bianco, this is recently. It says, the chart from Bank of America, B of A, Global Fund Manager Survey, that's B of A FMS, that's what he's going to show you in the chart here on the left side, FMS. The survey's out, and it's saying that they've been overweight bonds, particularly treasuries. So basically what he's saying is asset managers are overweight treasuries. And this is not just like hedge funds, this is pension funds, endowments, and here's a chart. And you can see here it's saying net percent expecting lower long-term rates. Like looks like it's the highest in history, right? So he's saying this is proof that everyone's sitting on the same side of the seesaw. Everyone's expecting lower long-term rates, but it's not happening. Rates are going higher. So they're not going to be able to have an appetite to buy more treasuries. And this is why treasury rates are going up, and they're going to continue going higher. And this is what he's saying. He's saying for various reasons. I'm going to show you, looking at some other charts, these various reasons that interest rates are going to go higher. And this is what I'm saying, by the way, is a false narrative. Because I have conviction that rates are going to go low, but everyone else is saying that rates are going to go higher. So here we go. Here's one example. This is the true inflation rate, and we could see here it's been going down at like a 45-degree angle, and now all of a sudden it's flatlined. It's actually gone up the last few weeks. So that's meaning that rates are going to go higher. Now, if you look at data from Charlie Bellello, and Jim Bianco focused on this too, he's saying that Japanese long-term rates are going up. And what Jim Bianco focused on is that the not B of A, the Bank of Japan, B of J, the new governor of the Bank of Japan actually increased that band of the 10-year rate, meaning they're increasing ever so slightly the ceiling that the Japanese government bonds could go, meaning they could go higher. And so if the Japanese government bonds go higher, there's going to be less appetite for Japanese investors to buy US Treasuries. Hence, US Treasury rates are going higher. Next chart. Now, Charlie Bilello is saying the streak is broken. After a record 12 consecutive declines in US inflation rate, we saw a small tick higher in July. Again, and this is CPI, by the way, CPI moving up from 3% to 3.2. Again, we're seeing the narrative change that inflation is going higher. And to me, this is just noise. When it goes up 0.1, 0.2%, that's noise. I think, and I've said this for the last 2 years, I think, or last year, that inflation is going to go down, but towards the end where we start hitting 2.5%, 2%, it's going to be more difficult. Obviously, it's easier for inflation to go down from 9% to 3% than from 3 to 2. But now they're making it sound like in a new narrative, the latest narrative is like, oh, it's going to be tough for inflation to go down. I'm going to bounce up and down here, and it's going to go up short term. And another example is gasoline prices. They've been soaring lately. Again, the narrative is that inflation is going to go up. I agree that the supply and demand situation for energy is getting tighter, meaning higher energy prices. But what I'm saying is, what I disagree with is that they're saying that the big increase, consecutive increase in interest rates for 10-year notes, 10-year bonds, 10-year notes and 30-year bonds, this week over week increase in rates, they're saying it's all due to these recent factors like gasoline prices, oil prices, inflation rate, the Japanese interest rate, the Bank of Japan moves overseas. They're saying that these moves are causing these long-term rates to go up, and I disagree with that. I didn't show you the last move. I'm going to search it right now, and you can see right here. This was also blamed for the big increase in rates. This is Fitch warning a potential downgrade of major banks. Actually, it's what's going on here. Someone's giving him a shot. Actually, I want to show you this one. Fitch Sovereign, U.S. rating downgrade. Nothing like doing stuff on the fly. So it says here, this is banking. It's a U.S. credit rating. Okay, the Fitch, let me just here it is. August 9th, Fitch downgraded U.S. debt. Now they're blaming this downgrade for the reason why rates went up. But if you remember, when the Fitch downgraded the U.S. credit rating, that's not why interest rates went up. It's because of economic data, which has been stronger. So you have to be very careful with this news. So let's go to the next point. U.S. government spending. U.S. government spending is rising rapidly. And if you look here, tax receipts are going down rapidly. And the federal budget deficit's going down rapidly. We have a big budget deficit. Interest expense is going up rapidly. So they're using all of this to say that the long-term rates on 30-year bonds and the 10-year note are going up. But this has been going on for a while, this issue with the debt to GDP being too high, interest expense going up. This has been going on for a while. So to me, just to make it clear again, let me maximize myself. Just to make it clear, the recent narrative of 30-year rates and 10-year rates going up week after week, month after month, has been all these charts that I've shown you, including from smart people like Jim Bianco. Now I'm going to show you the countermeasure, which is, let me minimize myself here. I'm going to show you the counter narrative. The counter narrative, meaning the opposite view, is that rates could actually go down rapidly. And how do I know this? I look at something called commitment of traders, and this comes out from the CFTC. And if you look here at the 30-year bond, and I have to explain this to you, this is going back 10 years. So this is a 30-year bond. So as bond prices have been declining rapidly, you could see here in green, the net positioning is shorting. So when you see here, that's minus 186, that's a net short for hedge funds and speculators. And in red here, that's commercial dealers. That's a net long. So we have the largest net short positioning of speculators we have probably in history. And it's not just the 30-year treasury. What I like to do is look at other products to see if other products are giving similar stories. So when I say product or products as plural, I mean like the 10-year note, the 5-year note. So let's look at those. So if you look at the Ultra T bond, there's the highest short position, and that's in green here. You can see 445 net short and 412 net long from commercial dealers. So this is saying that everyone's on the short side. And let's do it again. Let's find another one. 10-year note. Again, lots of shorts. You can see the green here is at the lowest position in history. Let's do one more. The Ultra 10-year note. You could see here we're at 149,000 contracts net short, and commercial dealers are at the highest long position they've been in history. So which one is it? Is it that everyone is long the market, like I said to you initially? You remember initially Jim Bianco said that everyone's overweight. Or is it this? So again, let me be more specific. Jim Bianco said everyone's overweight 10-year treasuries. And you can see it from the B of A survey. Or is it this? I tend to rely more on this. Why? Because, for example, this price went down from 160 to 113 since, what date is that? Since June 2020, it's been plunging. So usually when the price of anything is plunging, it causes people to become more bearish and to short that asset that's plunging. And I think of it that way because I'm a contrarian. But I'm not just a contrarian just to be a contrarian. If you look back in history, contrarians tend to do better. Meaning if you're a contrarian, you tend to do better in the market. So if stocks are crashing and everyone's bearish, and you turn bullish because you're contrarian, you tend to do better. So that's what I'm trying to say. You know what? If you don't believe me, let's get a chart here. Let's look up, how about we look up crypto? Let's look up crypto's bull-bear ratio. And this is like this is a contrarian ratio. Let's get the timeline here. So if you look here, everyone is fearful, was fearful right here. And guess what? This was the low of crypto. And everyone was fearful here. And guess what? This is also another low of crypto. And everyone was bullish here. And guess what? This is near the high of crypto. So what I'm trying to say is you want to be a contrarian. And another thing you could do is look at this. This is one of my favorite charts here. This is a crypto fear greed. Oh, can't get it. Got to log in. Seems like I lost it. Hold on. Hold your horses. Oh, I was looking at the wrong one. Okay, here. This is the CNN Fear Greed Index. So this is not for crypto. This is for stocks. And what it's charting is the S&P 500 versus fear and greed. And if you look here, the fear and greed index was at this is at a fearful level. Below 18, below 20 is fear. And guess what? That was near the bottom of S&P. And you saw that time and time again. Look at this one. Right here, in May 2022, the fear greed index was one of the lowest in history. And guess what? We were near short-term bottom. And you saw the same thing here. The CNN fear greed index was very low, and so was S&P. And then when it was high, look here. Back in when we had an all-time high for stocks, the S&P 500, for example, was at 4,700, and the CNN fear greed index was near an all-time high. And you even saw that now. The fear and greed index was one of the highest levels ever. It was at 81.77. And guess what? That was at the short-term high recently in July, and now we're seeing a Nasdaq and S&P go down because of fear. There was too many investors were at a greed level. So I trust this level. So why did I talk about this? Because I was talking about the commitment of traders. Where I'm saying is I trust this level here of everyone shorting futures of treasuries. Why? Because treasury prices were going down. When treasury prices go down, people, investors, speculators get fearful. And that's how I segued into the fear greed index. So the whole point of this convoluted, complicated video I did today, I think I'm going to have to do another one that's clearer, is the whole point is be very careful of narratives. Because when narratives get bearish, that's the time we should think about getting bullish. That's the first point. The second point is I think that narratives change based on prices. So right now, treasury prices are going down because rates are going up. And so when rates go up, what happens? All the investors and speculators, and even some of the smartest investors and speculators that I respect, like Stanley Druckenmiller and Jeremy Grantham and Jim Bianco, the one I just spoke to you about, these investors, even these investors that are smart, they start getting bearish. So what I wanted to tell you is that you need to think on your own. One thing I forgot to tell you, which is very important, is I think we should not be bearish on treasuries. Don't listen to these guys. Because one thing I forgot to tell you is when the 30-year rate goes up and the 10-year rate goes up, they tend to be self-correcting. So you're thinking, what am I talking about by self-correcting? Well, let me get you a chart so you can see it. Hold your horses here for me. Thank you. So if you look here at the 30-year bond, let's go to 3 years. We're at the highest rate in 3 years. And you're going to see that with the 10-year note. This is why stocks are down today, by the way. But here's my point. These rates can keep going up forever. When they go higher and higher and higher, that acts as monetary tightening. So what happens is that slows down the economy, and it also slows down speculation. So when it slows down speculation and economy, stock prices go down. And when stock prices go down and economic growth slows down, guess what? Interest rates go down. So what I'm trying to tell you is there's a self-correcting mechanism to interest rates. So that's why I think it's not a bad idea to be going long treasuries, even long-term treasuries, because there is a limit to how much you can lose in treasuries, even in long-term treasuries. Remember, everyone warns you that long-term treasuries, like the 30-year bond and 10-year bond, have very long durations. So for example, if you buy a 10-year note, and it's a zero coupon note, for example, and interest rates go up 1%, what you do is you take 10 and you multiply it by 1, because that's 10 years by 1%, and meaning you could lose 10%. And this is like a CFA exam question, by the way. So basically, you could lose a lot of money in 10 years and 30-year bonds, because of the duration. But remember, there's a limit to it because there's a self-correcting mechanism to it and a reflexivity mechanism, meaning when rates go up, it slows down the economy and it makes stocks go down. So just be careful of that. Be careful of that, and remember, make your own narrative, and so that you have conviction when the time warrants. Sorry for talking your ear off, but I just want to explain this to you. And thanks for coming to Lem's Cryptoverse. Bye bye.